You're good to go. Okay, good morning everyone. We're going to start our webinar today. Okay, today we're going to talk about macroeconomic update as well as US companies earnings updates. Okay, for asset allocation strategy, we are mostly maintaining our stance, which is to overweight stocks, neutral to underweight bonds, neutral weight commodities, and to underweight gold. Okay, essentially, despite tactical sell-offs and year-long consolidations in some equity markets, the larger trend essentially is still up since March 2009. Okay, now macroeconomic conditions suggest that this bull run might not be over yet. Okay, on the US side, despite ongoing fiscal tightening, the economy continues to expand moderately. Forward-looking capex orders are positive, employment gains are reasonably good, and wage growth is accelerating again. Don't worry, we'll be showing you charts of these numbers later on. Now, the Eurozone, the recovery is still in its infancy. It just recently emerged from recession, and the growth is weak. Consumption and production is recovering, and inflation is very low. So this gives the ECB room to cut rates further to give the economy a boost. Okay, so there is potential of small growth for the Eurozone. Now, China, it seems that growth has bottomed out. Services reaccelerating faster than manufacturing, in line with rebalancing the economy to more consumption and less manufacturing. Profits and output are rebounding, and the third plenum suggests positive catalytic reforms ahead. Although we do note that rising housing prices does remain a risk. Okay, for Japan, monetary policy is spurring confidence in Japan. Okay, so manufacturing is rebounding, machine orders is soaring, corporate earnings is growing, as well as increased sales. At this point, structural reforms of the economy is still wanting due to Abenomics' third arrow, but the medium term looks positive. Singapore is also positive. Growth is likely to be on the upper end of MTI's forecast, 4%, on the back of the regions all improving. Singapore's industrial production and exports are both seeing a pickup. Construction continues to add to the economy as infrastructure activity remains robust. Inflation is stable, and thus MAS is unlikely to run tight policies regarding SGD. This is a good environment for stocks. So overall, the environment looks friendly for stocks. Now, while QE tapering is back on the cards, we contend that such a scenario is worse for bonds than it is for stocks. As tapering ultimately signals a strong economy, the Fed has been reiterating of late that tapering is not tightening, so that's something to think about. We expect portfolios to rotate into stocks even if there is an interim tactical sell-off on tapering announcement. Okay. For the US, as you can see, manufacturing has been increasing in growth. New capex orders has been growing as well. Change in new farm payrolls, okay, has maintained itself in positive territory. Okay, so they've been increasing every year, and earnings have also taken an uptick as well. For the Eurozone, the recovery is more recent, as GDP only has quarter-on-quarter has only recently hit above positive territory. Full year-on-year has actually not turned yet, so this is a more recent recovery. Over here we see that the retail trade value has also upticked into positive territory this year. Although momentum has definitely turned, it has not gone into positive growth territory yet. Okay, but we know that even in this recovery, even though it's weak, the ECB still can reduce rates, as you can see over here, to basically add liquidity to growth. For China, we see pretty strong economic numbers. The China PMIs have also been in positive territory and upticking as well. Our rough measure of trading activity, which is China transport industrial production by volume, this is a very rough measure, but it does show you that there is also a recovery over here. Industrial profit has definitely upticked into positive territory right here. Now, the only we do see a potential risk into the new price, the China housing prices. Now, as to how high this has to go before it becomes into a real threat is debatable, but we do note that this is a potential risk. So right now in China, we do have very positive economic numbers. Um, uh, the growth is picking up, but the risk from housing remains. Okay. For Japan, same. There's growth strengthening this year for almost every matrices. We have the positive PMIs, increasing machine orders. Inflation has increased by design as well, and you can see an improvement in corporate earnings. So Singapore, same. So since this year, early this year, we have an uptick in industrial production. You can see our year-on-year 3-month moving average gross exports has also sharply increased. Construction awarded and output has been very consistent. And our CPI is still very manageable, basically. Okay, so overall the macro conditions suggest these things. So overweight equities, neutral weight industrial commodities, underweight gold. We know that gold is longer term bearish and short term bearish as well, so please stay out of gold. Neutral weight underweight bonds, okay, longer term bearish, but on the short term there is weakness, but there's still no confirmed breakdown of the multi-year uptrend line, okay. And the STI we are overweight on that, although right now we do note that there's a short-term consolidation right now. Okay, so let's look at the charts itself. We know for gold, we did mention that it was longer-term bearish, and that we had to wait to see what's going on in this consolidation. So of late, this week, we see the price break down this level here, which signals a short-term bearishness as well. So this is short-term and long-term bearish. So we urge investors to not go into gold at this point. S&P, we note that the price is grinding higher. It is a move, and this move is actually launched off from the top of this support line. The top of this ascending triangle is what I call support. I did mention that to take a look to see whether the price would actually come back down to the channel or actually lift off. So it has been lifting off and it's been grinding higher. So it is on an uptrend. Although we do note that the breadth indicators is still negative. Okay, as you can see, it's below 0, but there is a divergence, as in it's actually getting better here. Okay, so this grind higher. I'll say the breadth is improving, but it's still not great. So, but at the same time, technically speaking, right, this is still on an uptrend unless the price actually falls back into the channel, this triangle channel here. So we assume it's still an uptrend until then. For sector glances, just want to point out really quickly. If you look at the overall trend of the relative strength, okay, which is the bottom of all the charts here, for all the different sectors, you see that the offensive sectors have been on a very clear outperformance uptrend, okay, versus S&P. The cyclicals are up, as you can see, is channeling upwards. Industrials is channeling upwards. You see materials is channeling upwards. Energy is channeling sideways, as you can see, sideways, so it's not leading yet. And consumer staples all trending downwards, and utilities. Okay, of course, you can always have gyrations in the channel. In this case, it's a short-term up move from October to November, but as you can see, it's still a channel. Okay, so we note that offensive sectors are up, energy is sideways, and consumer staples and utilities are down. So this is just to verify where we are on the economic cycle. We believe that we're still in the expansion mode, and the expansion mode favors these sectors on the medium term. Basically, industrials, materials, and energy on the medium term. Intermarket, we have our 3 asset classes, US Treasuries 10 years, Dow Jones World Index, and the GSCI Commodity Index. So we note that yes, there is short-term weakness over here in the treasuries, but we still haven't broken down this multi-year downtrend line. When this breaks, this will signal this if it does break, it will be very significant. Okay, but so now we note that there is weakness. Price is probably going to trend all the way down to this trend line, and then we have to see what happens after that. For Dow Jones World Index, we are still continuing our multi-year high. For commodities, same thing. We are neutral on this because we are yet to break out of this downtrend line. Okay, but at the same time, the retracement levels of this down move, right, is starting to get to significant support line, which is here 550. So right now we are just neutral about this. Okay, but for commodities, we technically we are still on a downtrend. Okay, revisit of our potential trade here. So since we called the buy around this date over here, price has moved all the way up to here. We note that now the price seems to be grinding and consolidating. So we urge more conservative investors, if you're trading, to just lift your stop loss to $49 if you want to just protect your profits. Okay. Although fundamentally we do see more upside in the oil service sector, but technically speaking, right, it's possible to correct downwards. So, okay, so we just note that the potential for correction in this chart. Once again, we reiterate that for phase 4 is where we believe that we are in. This is where we are, and this favors stocks and commodities, but we do not favor bonds at this point in time. Okay, let's revisit the China chart. So last week, we mentioned that because of the news of the third plenum, that it's possible for price to challenge the multi-year downtrend again, and we got to see whether it's going to break through, because a breakthrough will be the first sign that corroborates our double bottom thesis. So as expected, this week the price did surge up, and it really did challenge the multi-year downtrend again. So we need to keep our eyes peeled this week to see if there's enough momentum to break over this line. If this downtrend line gets broken, right, the most immediate target is probably going to be 2400. Okay. For the STI, we note that price has been consolidating for yet another week in this sideways channel, and essentially, because of the macroeconomic reasons, we are bullish on the longer term, but technically speaking, in order to continue the uptrend, price has to break above this consolidation pattern, and especially above this blue resistance pattern here. If price can get above this, then we will probably see a move to at least 3400 or 3450 at least. Actually, I believe that if the price actually breaks over this blue line, right, the probability of challenging the multi-year high is extremely high. It's very good. Okay, that's it for the market analysis. I'm going to leave you to Yong Kai, who talked to you about his US companies update.
Hi, morning. Yong Kai here. I'm the US equities analyst. So today I'll just be talking about the 6 companies that we are currently covering and what's the third quarter earnings update. Okay, so firstly, General Financial. The share price is $15.20, which is on the higher, which is on the 50-week high. Market cap is $7.5 billion, and this is the S&P 500 components. So for the third quarter, actually, it did very outstandingly. The US mortgage insurance, even though it made a tiny loss, but it expects full-year profitability. $440 million of loss mitigation savings exceeded the full-year targets. Okay, more importantly, nearly half of the total policies are written after 2008 now, and they are very profitable. They have 20+% ROE. So this is the first leg of this company, because we think that this is a good proxy for housing recovery. Secondly, international mortgage insurance loss ratios are down sequentially and year over year. They are around 20 to 30%. In layman's term, if you take in $1 premium, you're only paying out 20 to 30 cents of losses to the policyholders. Canada continues to generate excess capital, 9% dividend increase, whereas Australia IPO remains in the pipeline. Note that this is not essential for its capital plans, but this will be a good way to monetize this investment. Long-term care received regulatory approvals. So in the half year, from the first quarter to third quarter, they actually received about $100 million of premium rate increase. What I want to highlight is that only 5% of policyholders chose to forfeit their policies upon this increase. 12% took reduced benefits to exchange for the constant premiums. Overwhelming 83% accepted the rate increase. So this reflects the importance of long-term care to the policyholders. Most of the dynamics discussed in the first reports in June are still being played out. General has really returned 25% since the report published 2 months ago, and 44% since the June report's first the first June reports. Okay, in November, one of the competitors, Essence, actually priced its IPO at $17 per share, beyond the expectations of $13 to $15. Okay, and they rallied 33% on the day one of trading. So this is the investors' enthusiasm and optimism towards mortgage insurers. US mortgage insurers, for valuation-wise, we computed using the enterprise value over post 2008 book, because this is a profitable book. This is a profitable insurance that they are underwriting. Life insurance valuations capped at 0.8 times PB, and Canada MI capped at 1 times PB. Australia MI, because they have slightly lower excess capital, so we actually lowered the valuations to 90% of the Canada MI. All in all, we have a revised target price of $17.80, which is just 1% lower than the previous reports, and it's nearly unchanged. This is how we computed US life insurance and the US mortgage insurance. These are the two bigger components, and the rest make up for it. We applied a 20% conglomerate discount to the subtotal to arrive at our target price, and the calculated upside is 17%. This is a trading by Iconics Brand Group. The share price is $38 on the slightly higher end of 52-week range, market cap of $2 billion. Okay, just a slight quick recap. This is the number 2 global licensor after Disney, $13 billion annual retail sales. Business model consists exclusively on licensing out its brands. So it receives royalty fees for this and bears zero inventory risk. Don't have to rent any retail area, for example. Revenue, EBITDA, free cash flows, they're all higher year over year by 24 to 27%. They set up a JV in Australia this quarter, and the international business is expected to contribute 40% revenue in 2014, up from today's 33%. They also spent $400 million to repurchase shares since the start of 2013. Compare this to this $2 billion market cap today. So what we really like about this company, there's good liquidity. There's about $600 million of cash and credit facility that you can use for the brand acquisitions. 2014 guidance is in line with our assumptions and ignores any contributions from unannounced brand acquisitions. We previously recommended trading buy in August at $34. So Iconics share price has really gained 12% since, but the positive outlook and lower share counts encourage us to revise our target price upwards to $45. So there's still a further upside of 18% from here. So these are the assumptions that we used. 2014 guidance, $198 million after you adjust for the stock-based compensation. We take the medium-term WACC and we factor in 3% terminal growth. So Iconics fair value, we see that it's $45, and at today's market price, it has a calculated upside of 18%, and we reiterate a trading buy. Third, okay, so the next two companies we are going to cover is the oil services and equipment sector. First one is NOV, National Oilwell Varco. Share price is $84, market cap is $36 billion, and there's also a component of S&P 500. So I'll just quickly gloss through these slides. What I'm trying to say here is that Rig Technology, the largest revenue contributor to this company, year-over-year change has a double-digit increase. Its operating margins across all segments have also increased sequentially as well. So this is actually a good turnaround play. Okay, another thing that a few things I'll highlight is the Rig Technology. The backlog is up 30% year-over-year to a record high. Whereas for distribution and transmission, you can see that operating margin is 5.8% on 1.3 billion revenue. So both in terms of profit and revenue contributions is the lowest, but they actually announced a spin-off plans, and so this segment could actually benefit from more management focus. What's noteworthy is that NOV equipment is actually present 90% of drilling rigs worldwide. Also, the operating margins have improved quarter over quarter, and there's still room for improvement because they are lower year over year. We recommended trading buy earlier at $79 on the basis of 14.5 times forward PE. We still think that this is a decent valuation, and we think that there's a further upside of 8.4%. So these are the assumptions, the calculations that we used, and we think that from today's market price, there's a calculated upside of 8%, and we reiterate a trading buy. So the second oil services and equipment sector company that we will cover is Oil States International. Okay, share price is $104. Market cap is $5.8 billion. One interesting is that there's the billionaire hedge fund investor, David N. Horn, which is involved with this company. So accommodations they actually fared poorly because there's overall weaknesses in hard commodity prices. What this segment does is actually provides lodging to mining projects. But if you exclude the impact of exchange rates, revenue is only down 4% and EBITDA is down 9% year over year. Okay, the two stars is actually completion services and offshore products. Okay, this is the second and third paragraph. The revenue growth was 16% for completion services and 28% for offshore products. Okay, so for drilling services, yes, the revenue declined because of lower utilization, but overall for this, EBITDA is still up 5%. So in short, accommodation spin-off still proceeding as planned. It's RevPAR, which is revenue per available room. It's calculated by using occupancy rates times the average room rate per night. This is actually comparable to Marriott's $112. Operating income for the past 9 months actually although it's lower year over year, but still 12% higher than our estimates. Offshore products, commercial services, remember they have double-digit revenue growth. They perform well and will account for 90% of the overall EBITDA after spin-off. In all, we still recommend trading buy, and we think that there's a further upside of 15.8% using the sum of the parts valuation and catalyzed by activist involvement. So again, this is how we arrive at these figures. So with the fair value will work out to be $121, and based on today's market price of $104, calculated upside is nearly 16%, and the trading buy. Okay, next, the two companies that we'll go talk about is the trading cells, and we are still reiterating them. For Bank of America, it's $15, and it's actually at a 52-week high. Market cap is $166 billion, and the S&P 500 components. So very briefly, I'll just go through the performance. Okay, it's actually a mixed set of results, range from difficult to good. Reduction in credit losses and the gain on divestment, the divestment gain on CCB share sales actually accounted for 60% of the pre-tax income increase. Okay, so I want to highlight to you this consumer real estate services. They continue to deteriorate because of compressed mortgage production margins. They actually benefited so much from lower credit loss provisions that they are recording a profit of $308 million for these segments. Okay, for credit losses, for setting aside money for credit losses, they earned $308 million. Okay, as for the all other segment, the performance boosted by nearly $1 billion put reduction in credit loss provisions and another $750 million gain from sale of CCB shares. So here we have these charts. You can see that they actually have been consistently registering lower provisions compared to the charge-offs, which is a balance sheet item. So as of this quarter, third quarter, they actually recorded only $200 million of provisions. Compare this to the market cap of say $166 billion. Okay, all this while they've been releasing reserves, which is actually a legitimate move. But one our point is that they've really this all-time low. Can you still go lower than your $200 million provisions? There's only so much reserves that you can let go since your start of 2011. And one they're saying is that the net charge-off stabilizing at $1.5 billion in 2014 is a metric not seen since 2006-2007. And share price wise, Bank of America actually continued to perform at a premium tangible book, which is even better than Citigroup, even though Citigroup has better ROE and efficiency ratio. So Bank of America share price has outperformed the rest, 58%, versus even Citigroup, which is the next best, is only around 42-43%. Investors appear to have taken the successful settlement for granted. Okay, this is disputed in court right now, and we think that the lead key plaintiff, AIG, might have some merits. So for perspective, right, the $8.5 billion settlement is supposed to cover $109 billion of delinquent loans, and this is actually more than 1/4 of what was sold to them. So if investors are currently taking this successful settlement for granted, we think there's minimal upside even if it's approved. Meanwhile, they are still facing 3 additional probes and from Department of Justice, who has also fined JP Morgan $13 billion over similar violations. This $13 billion fine doesn't cover any settlements. So in all, we think that because based on this trading 12-month gains of 58%, we think that there's very little upside left on the table. We iterate a lower target price, and we recommend investors to stay away. Last company, Garmin, is a GPS manufacturer. So share price is $48, which is also on a 52-week high range, higher end of 52-week range. Market cap is $9.4 billion, and the S&P 500 components. What's interesting is that this company overall net sales is declining, but this automotive mobile is actually masking the results of fitness, aviation, marine, which registered double-digit revenue growth year over year. So even though the margins, the operating income, the overall net sales are decreasing, but this actually is better than expected, and the market has actually rewarded it by giving it a 50% increase since the 52-week low. Market has really recognized the value of other growth segments. So if you exclude the cash balance, which is roughly 2 billion excess cash, Garmin now trades at 13 times price over free cash flow, up from the 8 times multiple in the first reports. We actually recommended a trading buy much earlier at $34. In August, after the second quarter results, we advised investors to sell into positive sentiments. They have really recognized 17% return since. Unfortunately, I'm wrong, and the share price has actually increased a further 20% to $48 today. In the absence of any material announcements, such as special dividends or rave product reviews, we still continue to advise early investors to lock in profits. So if you have heard our trading buy call and acted on it in April, you have been looking at 40% returns since the first reports. Okay, so that's all we have for the US coverage. 4 trading buys and 2 trading sells. Now we are open to Q&A. Thank you.
There's a question on the market analysis. Is the breadth indicator used the same as the McClellan oscillator? Yes, it is. I just want to quickly just show you what I was using. There are a couple of breadth indicators that I use, but for this one, I just decided to use the McClellan, and it's this one here. So on the S&P chart itself, on the bottom subchart, the NYMO, this is actually the McClellan oscillator, which is the breadth indicator that I use. Okay, another question is, can you please explain how do you measure breadth or depth for S&P and other markets? Okay, I'll give the S&P as an example. Okay, different service providers gather data for different markets. Okay, so depending on the service provider that you use, you may or may not have data on the markets. So in this case, because the S&P is a heavily traded index, right? There's data on this market. So what is it? What is this particular breadth indicator, McClellan? What it does is that just as the S&P measures the price movements of 500 different large caps, what this does, it doesn't measure the absolute price changes. It just notes down on a day-to-day basis how many stocks went up as opposed to how many stocks went down. So it gives you the number of stocks that went up versus the stocks coming down. Now, if you take a cumulative measure of the amount of stocks going up and coming down, that actually is not the McClellan oscillator yet. That's just the advanced decline line. If those who are familiar with technical analysis will probably be familiar with the advanced decline line. So if I took a cumulative total of the number of stocks that went up versus the number of stocks that went down on a day-to-day basis, that will give you the advanced decline line. Now, if I take a rate of change of the advanced decline line, that gives me the McClellan. So in short, the McClellan oscillator gives me the momentum of the change in the number of stocks going up versus going down. So when you see, for example, the McClellan hit positive territory, that means not red, it means that on a day-to-day basis, there are more stocks going up than stocks going down. That's basically what it means. Next question. Can you use the McClellan oscillator for the STI And the answer is actually yes, you can. But the problem is that, as far as I know so far, most service providers, right, they don't have that ready information. In other words, if you wanted to do a McLennan oscillator for the STI, you could, but you have to do it yourself. So you would have to have a program that calculates the number of stocks that went up versus number of stocks that went down, and then you would have to monitor it basically every day.
Hi, so we have a question on UE. UE reported 2013 third quarter results. What do you think of the results? And the third quarter result seems good if the income tax is stripped out. Will the fourth quarter result be better due to the gain in divestment? Okay, so UE, just again to refresh memory, this is actually non-written reports. We're trying to make just very factual comments. Okay, what we see is that UE is more of an asset play than an income play. So you should actually strip out all the. You actually shouldn't be looking at the income statement for forecasting purposes. Yeah, you should look at the asset, and so far it actually worked out. Yeah, I mean of course the WBL, the automotive segment isn't doing that well, but the engineering segment is doing good. Okay, the danger about using the income statement to do forecasting for UE is because now they are recognizing their property developments on the they're actually recognizing results only upon completion, so it's going to be very lumpy. And it's hard to make a call on it. Yeah, so in short, just say that for UE, look at the asset value rather than the quarter-to-quarter earnings. Yep, that's all. Okay, and now I'll pass on to colleagues. SIA Engineering. Yes, OUE Singapore. OUE Singapore analysis.
Hello. There is a question to actually ask that could you please give your analysis for OUE Singapore? Currently, right now, OUE is having a proposal to spin off the OUE commercial REITs. For this, the results will still be consolidated with their financial statement. It will still be consolidated accordingly. As per now, from what we see, we will expect them to actually receive another potential cash of maybe about 600 million, and we do foresee that they would be giving a good a special dividend again should this go through. So for now, we are still quite positive on it, and we'll still maintain our accumulate rating for OUE Singapore. Thanks.
Okay, we have another question for UE with the acquisition of WBL. With the acquisition of WBL drag down the performance. Okay, UE and the considered parties really own 96.3% of WBL. So actually, they really own everything already. Even if they acquire the remaining floats, which is roughly 3.7%, that's less than 5% of the UE's current stake in WBL. So it's actually very inconsequential, and it shouldn't impact the performance, if any. Okay, just give us a minute while our colleagues will get back on the rest of the questions. Thank you.
And also, just to add on, once again, we will be sending out the slides after the presentation.
Hi, Kenneth here again. Okay, question is, given the fact that STI is in a consolidation mode and we are approaching Thanksgiving Day, is it good to adopt a wait-and-see approach in the market given the fact that we are nearing year end? I think that question is depending on whether you are an investor or a trader. I think a longer-term investor will see the positive macroeconomic environment that is good for company earnings, and they can invest at any time. But I guess if you're a short-term trader, right, I would say that in any consolidation, it is useful to wait to see which way the consolidation actually breaks before deciding. Yeah, so as a trader, I would wait to see if the consolidation breaks upwards, then you can take that as a signal to get in. Yeah, and obviously if the consolidation breaks downwards, then you can just take your time and wait for the next consolidation before deciding what to do. Okay, here's a question that says, what is the view on S&P and NASDAQ index? Sorry, what is the view on S&P and NASDAQ index level and the maximum top level it will reach before turning down? Okay, the thing about okay, let's look at this chart over here on S&P. The NASDAQ has a very similar look in the sense that it's challenging. It's already at its multi-year high, or it's challenging its multi-year high, but breadth is not encouraging. So it's got the same look. So so when you deal with charts like this, you have to note that it is on an uptrend because it's breaking new highs. Whether or not how oversold it is would depend on a few things. It's hard to put down an absolute price target on how much high it can go. In terms of how much high it can go, probably fundamentals would be a gauge as well. And I know that for the S&P, fundamentally the PE levels is just slightly more than average historically. So it's actually not expensive. It has potential to go higher. It is not expensive fundamentally. But at the same time, I do note that this grind higher, it's a grind with weak breadth. So I can't tell you exactly when the top will occur. But as now, right, we still have upward bias, although we do note that it is weak. Whether or not we can call a top will probably depend, technically speaking that is, will depend on the chart formation that I see. So right now, since I don't see any sharp signal like an engulfing candle or longer term formation like a double top or head and shoulders, since I don't see any of these things, I'm going to have to assume it will continue grinding higher or sideways and not a top yet. Another question is, as for the NYMO, the McClellan oscillator, in the month of May, we note that there's a black mountain above the zero line in the month of May. Yes. Does it mean that more stocks that go up in the month of June? Okay, I'm not sure what you mean, but yeah, in May, we say that in May, the momentum of the number of stocks that number of stocks that were increasing as compared to those decreasing was much higher. Yeah, so usually for the McClellan, it's always good to see when the McClellan actually cuts the zero line, because the zero line is the point where the number of stocks that go up is suddenly more than the number of stocks that go down. That's a confirmation indicator that gives you a confirmation on your cycle up. So most technical traders, right, so, when they look at cycles, they might look at the RSI or they might look at the MACD. But these are momentum cycles based on the price itself. So the McClellan oscillator can give you a confirmation on your cycle. So if your MACD turns or your RSI turns and your McClellan cuts zero, you can see that's a confirmation that it's probably cycling up on the shorter term. So that's how you might want to use the McClellan oscillator. It's pretty useful actually. Okay, question. Are there bearish divergence signals for Dow Jones and S&P? Okay, the thing is this, based on the current pattern, right, there is a very, very small minor divergence right now for the S&P, but it is still very minor, and that's why I say it's still grinding higher. Okay, question. What is divergence? A divergence means basically, essentially when you're looking at price charts, let's say S&P in this case, divergence means that some other indicator that you're using is basically trending in the different direction. And when you see two indicators trending in different directions, it makes you question the strength of the move. So for example, in the chart that we're looking at now, you can say that there's a very minor divergence in the RSI. Actually, I don't really think it is a divergence. In the sense that the S&P has been grinding higher for 1 month, but the RSI did not go higher. So that's a minor divergence. A bigger so-called divergence would be between the S&P chart itself and the Russell versus S&P relative strength index. That is probably a better divergence, but we note that the relative performance of the Russell and S&P of the last 1 month has been stable, it's been level, so that's not quite divergence either. Okay, hi. Okay, thanks for tuning in. We're going to close this session for this week. Please tune in next week for more presentations.